Debt Market Update, January 2021. The yield of 10-year benchmark G-Sec ended the month at 5.91%, up 4 basis points over the previous month end. The G-Sec yields traded largely within a narrow range during the month, supported by high liquidity, Operation Twist, etc. The spread between 10-year AAA rated corporate bond and 10-year G-Sec was largely stable during the month. Average net interbank liquidity surplus was largely similar to the last month, supported by higher government spending, OMO purchases, foreign exchange purchases by RBI, and soft credit growth vis-à-vis deposit growth. The FPI flows in Indian debt markets have been relatively muted in the current financial year. In January 2021, FPI flows in debt turned marginally negative and recorded a net outflow of $0.7 billion compared to net inflow of $0.3 billion a month ago. On a cumulative basis, in 10M FY21, net FPI outflows from debt markets was $2.9 billion compared to net inflows of $1.5 billion during the same period last year. In its Union Budget 2021-22, against market expectations, the government announced additional borrowing of INR 800 billion for FY21 and projected a high budgeted fiscal deficit of 6.8% for FY22. Further, the government relaxed fiscal consolidation timeline and fiscal deficit is expected to be below 4.5% by FY26. These resulted in G-Sec yields rising sharply across the board since budget. In its meeting concluded on 5th February 2021, MPC unanimously voted in favor of keeping the policy repo rate and reverse repo rate unchanged at 4% and 3.35%. It also voted in favor of maintaining an accommodative stance as long as it is necessary, at least during the current financial year and into the next financial year, to revive growth on a durable basis and mitigate the impact of COVID-19 on the economy while ensuring that inflation remains within the target going forward. However, as against earlier plan of restoring the CRR to 4% of NDTL by 27th March 2021, RBI announced that it will happen in a staggered manner. Now, banks are required to maintain CRR of 3.5% by 27th March 2021 and 4% by 22nd May 2021. Earlier, RBI had increased the limits under the HTM category for banks to 22% of NDTL from 19.5% for the SLR securities acquired between 1st September 2020 to 31st March 2021. This dispensation was allowed till 31st March 2022. Keeping in mind the increased government borrowing program, RBI extended this dispensation to SLR securities acquired in FY22 too, and also announced that restoration of HTM limits will happen in a gradual manner starting 30th June 2023. Outlook. The RBI's decision of leaving the policy repo rate and accommodative stance unchanged was largely in line with market consensus. However, given the large borrowing program announced by the government in Union Budget 2021-22, the expectations that RBI will announce some measures to ease the borrowing pressure were high. In absence of any such steps, the market was disappointed and yields rose significantly. Since the last couple of months, multiple factors have impacted the debt markets adversely. These include international crude prices have inched up significantly. 10-year US Treasury yields have gone up, higher than anticipated government borrowing, relaxation of fiscal consolidation timeline, domestic fuel prices being all-time highs, etc. All these factors have resulted in G-Sec yields rising significantly, especially in the last couple of weeks. We expect that these factors will continue to impact G-Sec yields, at least in the near term, and thus yields are likely to trade with an upward bias. Further, high SLR holding of banks and signs of broad-based improvement in economic activity can also push yields higher. However, as has been the case over the past year or so, we believe RBI will continue to use conventional and unconventional tools going forward as well, thus limiting the increase in G-Sec yields. Further, the RBI governor mentioned in his speech on 5th February 2021 that RBI will maintain ample system liquidity and normalization of CRR opens up space for a variety of market operations to inject additional liquidity. Also, the statement by the RBI governor that it will manage the government borrowing program in a non-disruptive manner provides some comfort. These factors should have some moderating impact on yields. Again, a comfortable outlook on balance of payment, low global rates, and ample global liquidity also bode well for yields in India. In view of the above, we expect yields to trade with upward bias, though the upside should be limited to a certain extent. The risk to this view is that the fiscal deficit turns out to be lower than anticipated, either due to lower expenditure or better than expected tax collections, along with lower inflation from Q2 FY22 onwards. Considering the above, we continue to recommend investment in short to medium duration debt funds, albeit in a staggered manner over a period of time depending on investors' risk appetite. While the credit environment still warrants caution, measures by RBI have eased the spreads on AAA-rated bonds significantly. However, opportunities exist in select pockets of non-AAA-rated bonds, as their spreads relative to AAA-rated bonds are trading at an attractive level. Hence, allocation to credit-oriented schemes or funds with some non-AAA exposure can be maintained or increased in a phased manner in line with individual risk appetite. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.